回顾2025年全球经济在地缘冲突、国际贸易不确定性和科技浪潮的多重交织下，呈现出低速增长、深度分化的复杂途径。一方面，美联储开启降息周期，美国对外经济政策急剧转向，关税和制裁重塑全球贸易金融版图；另一方面，人工智能、绿色转型等新科技技术投资热情高涨，但却也被质疑究竟能否真正转化为生产率的提升。面对这些不确定性，中国在新质生产力、智能制造和开放合作上的探索受到了全球的关注。带着这些问题，南财记者专访了诺贝尔经济学奖得主、斯坦福大学商学院前院长 Michael Spence， 邀请他一起来系统地梳理2025年世界经济的脉络，并且一起来展望2026年全球增长前景以及风险。Hi, Michael. Thank you so much for joining us today. It's always a pleasure to see you.
Thank you for having me. It's a pleasure.
The first question is about looking back at 2025. Looking back at this year, how would you characterize the global economy, and what stood out to you the most?
Well, I think, for most people, what stood out was the fairly dramatic change in United States international economic policy. So that would include tariffs. It would include withdrawing from the multilateral institutions, at least some of them, the Paris Climate Accords, et cetera. And then probably a third item would be a fairly dramatic change in relationships with countries that were previously viewed as allies, trading partners, et cetera, both sort of in the economic dimension and in the kind of national security dimension as well. So those are pretty profound changes. And some of the global economy's trends precede Trump. The global economies was fragmenting. The shocks were causing shocks and geopolitical tensions were causing a fair amount of pretty dramatic diversification of supply chains. A lot of policies, enforcing that in the pursuit of national and economic security. So that was already underway. I think, from that point of view, the Trump administration represents both an acceleration of that trend and also the addition of these new elements that I mentioned before, which I think most people didn't anticipate. Certainly I didn't.
Have you observed the impact that the new tariffs have had on the world economy?
Well, initially, I think they were created a considerable amount of uncertainty. In the so-called Liberation Day period in April, I think there was a lot of, headwinds. Investment programs were slowed down or stopped, while people tried to figure out what was going on. That, I think, has settled down. And it looks like we're going to end up with a regime with tariffs of varying magnitude, but not so large to be, a complete disaster with respect to international trade. And I like to remind people that, the United States in the kind of in the trade area is only 25% of the global economy by GDP. And the rest of the global economy, I think, seems to me to be pretty determined to continue to trade and invest in each other. So it's a moderately big shock, but I think the uncertainty is fading. And the global economy seems to kind of be getting on with its life. But it's a very, very different global economy than the one we had, say, 10 years ago when this fragmentation process started, and with all the underlying causes of that.
From your perspective, looking back at the world economy in 2025, is a bigger challenge weak growth momentum or deeper structural imbalances? What risks or positive developments do you think markets are still underestimating?
Well, it's hard to say when markets are under or overestimating stuff, because in order to do that, you have to assume that you're smarter than they are. And at least I don't normally assume that, at least for my case. But I think that what the pattern you see is not uniform. I mean, there's divergence all over the place with, idiosyncratic characteristics. I mean, it's clear that there are positive, potentially very positive forces coming from the technology side. And I think, that includes not only the major producers of these technologies, that would be China and the United States, but also a great many other countries, in various categories, including a large set of emerging economies who will find ways to use these new technologies for highly beneficial purposes, inclusive growth patterns, delivery of services that were hard to deliver before, et cetera. So there's some very positive things developing. Um, on the trade side, I think trade is holding up reasonably well. I think until the full force, the potential productivity surge that may come from the deployment of artificial intelligence and other digital technologies, until that arrives, and that doesn't happen overnight, right? That takes time. Until that arrives, I think the preponderance of forces operating on the global economy are essentially negative, right? I mean, you have quite expensive diversification underway. You've got blockages. On the financial side, you've got potential imbalances everywhere. In the United States and many other countries, you have rising sovereign debt ratios that are believed to be unsustainable, but nobody really knows how that's going to get resolved, and so on. So, the American economy, some people say it's doing reasonably well, but it's being propelled along by very large investments in artificial intelligence and data centers and energy capacity to supply that. There's a bit of that is true in China as well. And Europe is a different story. It's wrestling with, two continuing or maybe continuing wars on its doorstep, divergences in kind of policy approach with the United States, some difficulties, resolving mutually satisfactory set of relationships with China and so on. So it's a pretty complicated picture. I would say there are competing forces at work, and we'll have to wait and see how they resolve themselves in the course of the coming year.
You've mentioned that the world is becoming more divided and that development is more increasingly imbalanced. Looking at emerging markets, which ones have shown resilience in 2025, and which do you think could become the main growth drivers in 2026?
So I would say India has been proved to be pretty resilient, seems to be holding up its growth. The most recent growth numbers were in the 8% range, which is quite good. India is obviously at an earlier stage of development on average than China. The per capita income's much, much lower. So its potential growth is higher. I would say many of the ASEAN economies are doing really quite well. And that they, of course, are heavily dependent on China and what's going on in China. China, I think, has a period of wrestling with these imbalances and restoring some degree of confidence. I suspect that will happen over the next 2 to 3 years. And then there are these very positive forces because China has become a kind of major powerhouse in science and technology development. So, compared to 20 years ago, that's really a completely new development. When you go past that, I'm not sure what to say about the African countries. If they, are reasonably successful in implementing growth-oriented policies, the growth potential is certainly there. They have young demographics and so on. But, they are exposed to the same forces that everybody else is exposed to in the global economy, contradictory requirements and so on. The multilateral institutions, without the United States as a kind of committed sponsor, are also in the process of, finding a new path, perhaps undertaking some reforms and so on. Like the global economy, it's not a uniform picture, but I would say, India and the ASEAN countries look like a bright spot, unless something, in the neighborhood happens that's really disruptive.
We've talked about advanced economies as well as emerging markets. What is your baseline outlook for the world economy in 2026?
I would say my baseline, if you average across all these things, is sort of, really somewhere between low and modest growth. Again, but that with the caveat that there's no really major disruption of the type that we've experienced before. Another relatively large scale conflict would do it, some big deterioration in the relationships between the major players in the global economy. That's US, China, Europe, um, and all that. But it looks to me like this. I think the positive forces are not yet strong enough to overcome, these challenges that come from fragmentation in the global economy, declining productivity trends, aging. These are all, not particularly helpful with respect to growth. One other comment, the United States is, I said before, it's 25% of the global economy. Probably, if you look at total assets by market value, it's much larger. Probably somewhere in the neighborhood of 50%, maybe even more. And so the United States remains in a relatively dominant position in the financial world, and that depends. So a lot of what happens in that part of the global economic system depends on what the United States does, what policies it pursues in that area. Are we going to have more sanctions? Are we going to have more requirements that people, don't trade with people that we don't want them to trade with? When I say we, I'm speaking as an American citizen. And we just don't know how that's going to go at this point.
Looking back at the macroeconomic environment in 2025, the Federal Reserve has already started a rate-cutting cycle and lowered rates a couple of times. How do you think this shift in U.S. monetary policy will influence global financial conditions in 2026?
So in general, when they're lowering interest rates, I think it has a tendency to ease global monetary conditions, um, and which is helpful. But the caveat is that if they do it too fast or too much, we'll get inflation. And then, unless they decide to live with inflation, which is not normally what central banks do, they'll have to change course. I mean, the Federal Reserve is facing a pretty complicated situation, in which we have some evidence of weakening in the economy, especially the parts of it that are dependent on the lower half of the income distribution. Some evidence of weakness in the labor markets. On the other hand, inflation seems to have gotten stalled in the 3% range, which is not their current target. And so, and in addition, the commentary on the Federal Reserve is that the governors, the people who make these rate decisions, collectively are not on the same page, right? They don't agree with each other. Some of them think we ought to have an interest rate cut. Some are pretty nervous about that because of the potential inflationary effect, and so on. So I think the market seem to kind of, ebb and flow. That I think the latest data pushes them in the direction of thinking they'll probably get a rate cut. And then, some people are nervous about, sort of a fairly significant bubble in the financial markets, which isn't entirely dependent on interest rates, but low interest rates certainly fuel that. If that bubble is related to sort of kind of growth company valuations and so on, so we'll see. But I think the Fed has this is a complicated economic situation for them to try to confront. I mean, I think they still are serious about the inflation target and probably aren't happy. But the Fed, unlike the European Central Bank, has a dual mandate. They're responsible for, well, it's really three. I mean, the two that are most talked about are inflation, keeping inflation under control, and encouraging growth and employment. The third one that almost all central banks are involved in is financial stability.
The Federal Reserve's Chairman Powell will end his term sometime next year, and US President Trump could appoint someone from his administration to replace him. How do you view this potential leadership change at the Federal Reserve?
That's a near certainty. I mean, Powell's term is up in the early part of next year. So, and I think he may stay on as in the Federal Reserve because his term as a member of the Federal Reserve. Mm-hmm. So his term as chairman is up. And I think there's near certainty that the president will replace him with somebody, for sure.
Do you think this change could affect the Federal Reserve's independence, and especially given that US President Trump has been very clear that he wants lower interest rates.
Well, he has made that pretty clear, yeah. So I think the Federal Reserve, I mean, it's sort of an open question. I think the Federal Reserve's independence is hard to take away in the short run, because the president either can't or doesn't normally, replace people kind of midterm, at least not unless there's cause. So on the other hand, over time, the president, as people's terms come up, does replace people, just as he does in certain parts of the judiciary in the United States. So I would say, the possibility that he'll appoint people to the Federal Reserve over the next year or two, including next year when he picks the next chairman, which is a very influential position, that would make the Fed, more closely aligned with what he thinks ought to happen. I don't know whether you want to call that, I guess that is in some sense a reduction in the independence of the Fed. I mean, they will still, unless Congress changes it, still have the same mandate. But they may, be inclined to sort of, follow policies that the president or the current administration favors. Central banks are, quote, independent. They're meaning they're meant to have the ability to make decisions in the interests of the economy in the dimensions where they have authority, without pressure from the executive or the legislative branch. But they can't be just completely unaccountable. And the accountability comes from the fact that the executive appoints the people who populate the Federal Reserve. So I think the short run and the long run in those respects look somewhat different.
Coming back to the Federal Reserve's dual mandate, price stability and employment, plus the third one of financial stability you just mentioned, I'd like to focus more on the labor market right now. The latest Beige Book notes a slight decline in nationwide employment, with about half of the districts reporting weaker labor demand. Do you see this as the early stage of a broader labor market slowdown or just a temporary soft patch?
No, I think there's probably a trend here. So that with some additional data, I think you can get a picture of what's going on. So the consumption in the United States economy is being held up because it's become heavily dependent on the consumption of the top, quartile of the income distribution. And that's being supported by very large increases in asset prices, right? And that is the group who owns the lion's share of those assets, right? So that picture looks positive. But then when you look below that, the consumption of the people, say, in the lower half of the income distribution and their incomes, taking into account real incomes, taking into account inflation, that picture looks much less attractive. And so the consumption patterns in those two groups of people are very different. And so when you get consumption weakening and maybe even investment weakening in sectors that tend to supply or tend to have, customers that are dominantly in the lower half of the income distribution, then you get weakening there. And I think that's probably part of what we're seeing. So again, it's a mixed picture. When you look across the sectors of the economy, probably luxury products are probably doing pretty well, as some of the kind of digitally related stuff still seems to be holding up. But I've seen evidence, by talking with the asset managers that certain kinds of, restaurant chains are experiencing weakening demand. And that's probably because their customers are experiencing, economic difficulties of a variety of kinds, uncertain employment, real income problems and so on. So again, the accurate picture, I think, requires one to dig a little deeper than the top level macroeconomic picture. But I think you have both elements of strength and probably weakening elements, and they are related to where various things sit in the income distribution.
At the moment, inflation is still around 3%, above the Federal Reserve's 2% target, and parts of the labor market appear to be slowing. At the same time, US government debt has hit record highs multiple times this year. Do you think the current fiscal trajectory in the United States is still sustainable, given that high debt is widely recognized as a problem, but there seems to be no clear solution yet?
That's true. No, I think in my view, which I think is, not different from that of most other people, is this the current trajectory of the deficits and debt is not sustainable. The difficulty is that people, when asked the question, well, so when and how is it going to break down? And the answer is we don't know, right? I mean, it depends on a lot of things. And so I think whether or not this is how unsustainable it is really depends on, among other things, on growth. All right. So if the people who think that we're not going to get that much growth from these new technologies and the intangible assets that are being built up, once it diffuses across the economy, if it does, then they think, well, the growth is going to be modest, and that increases their sense of, concern about the sustainability of the debt. There are other people who are more optimistic, and think we really could get a productivity surge, and that would modify. I don't think it would take all the concerns about sustainability away, but it would certainly modify the picture in a major way. And so underneath this question of the how worried we should be about the debt situation is closely connected with this question of are we on a trajectory where we will experiencing accelerating growth, over the next, say, 5 to 10 years, which is the kind of time horizon people talk about, when they're talking about, what's going on in the world of debt.